It's been a very strange market environment, and that's caused us to have some very strange market trends, some of which have happened that we didn't necessarily agree with. But that seemed to stabilize and return to what we expected. The trend in question that we're talking about right now, and we'll get to some more in a second, but the one that has already changed was the market's reaction to inflation. We've been saying on this channel for a very long time that we believe inflation is a good thing for markets. We think inflation is product inflation, but also stock market inflation. We've looked at the 1920s and 30s Weimar Republic and seen that the winners in that environment were the capital owners, not the normal people with savings and bondholders, the people who own the capital. And by owning stocks, we own the capital. Now, we've had inflation data coming out worse, hotter, more inflation, worse in normal times than expected for several months now. And every time we've gotten it, every time the market's been concerned about inflation, the market sold off. We viewed this as a short-term trend that didn't make any sense, and we just got our most hot inflation data, and the market turned up. So it seems that the market is now rationalizing that trend. But on that same May inflation data report, we also got one new strange movement, which didn't make any sense, really made no sense. And that was that bond yields rose when we had very hot inflation. And it looks like this has got to be the next trend that's got to rationalize. But we can't make predictions on when that's going to happen because the bond market is the most manipulated of markets in the world. Plain and simple. Maybe there's some African black market that is slightly more manipulated than the bond market. But right now, not just the U.S. bonds, every bond market is incredibly manipulated. And it has to be. That's what's propping up the economy. It's keeping the debt situation alive. And believe it or not, there's actually more debt than there is cash. There's more debt than there is cash. Strange thing to think about, but it is true. So we need to prop the debt market up in times of crisis. And that's what's happened, but it is manipulated. So we saw bond yields fall, meaning people decided to buy bonds, which suffer from inflation on a day when we had a lot of inflation. Doesn't make a whole lot of sense. Very strange. But it happened. Today we're seeing bond yields tick up again. It's a relatively quiet day. It's a good day for things to slowly start rationalizing. If it's a manipulated market, maybe the Fed did a whole lot of buying that day, pushed yields down so there wasn't like a shock move of yields up because that is scary and it is bad for companies and the stock market. Not totally, because real yields and nominal yields, the actual number are different things, but that's, we'll talk about that later. So it's possible the Fed was very involved on inflation day, manipulating that market, now taking its foot off the pedal a little bit, just a little bit. So, since it's become such a manipulated market, we're not saying what we think and where we believe rates are going to go and in what time frame. We're just going to say what we think is the logical thing. And that is when there's inflation, you got to require a higher interest rate to compensate you for your total return on your cash. That's just the way it is. And in the long term, we think that's going to rationalize. As for how long it's going to take, no idea because the market is manipulated. Is it happening now, today? Well, crazy to extrapolate a whole trend in one day. But we just got the data. We had a quiet Friday. And there was a slight move up. So, despite that, some tech stocks were holding up. Nothing crazy is happening. So, can't extrapolate a whole lot out of this. But we do think that rates are going to tick up. It's possible. We are wrong. We can't really say because, as we said, the market is manipulated. But that is the logical trend. The logical trend and the way we're positioning is for slightly higher rates. Expected in the long run. In the short run, maybe they keep staying here or going down. That is totally possible. And inflation, which we believe can no longer be hidden. And rates will respond to inflation. Inflation will occur first, so it's starting to happen now. And we want to take advantage of that because we're going to be shielded. We're going to do well. We're going to be ahead of the crowd. And then they're going to have a fear of missing out and pile in just like Weimar Republic people would do for bread. Rich people are going to do for inflation corollary stocks. So energy, gold, silver, real estate. We like these sectors and believe they are part of a portfolio, including miners, not just the actual metal. Miners, they can adjust their cash with the gold price. So we will see what happens. And until next time, peace out.